Hey everyone, welcome back to another deep dive. On today's episode, we're going to be looking at Wise PLC, formerly TransferWise. And if you haven't heard of this company, I wouldn't blame you. They've been focused on moving money without borders for the last 13 years. And we're going to dive into the fundamentals of the business, their competitive advantages, and also look at the valuation. So let's dive right in, shall we? So, as with all great businesses, they started with solving a problem for themselves. They were two Estonian friends, one Kristo Carmen and the other Tava Henrikes, and one was living in London and one was living in Estonia, and they wanted to transfer money the other way. And they were just astounded with, I guess, how much it was costing them, and they thought there must be a better way to do this. So what they decided was their light bulb moment was like, you have money in London, I have money in Estonia, I'll just send you, kind of like a peer-to-peer system. And that was almost like a Napster back in the day. I'm probably giving away how old I am, but that was the essence of the business. And with the backing of notable investors like Peter Thiel, Andreessen Horowitz, and Richard Branson, they got their start in 2011 in London. So let's look at the four key value drivers for this business. Wise is aiming to be the low-cost provider and the fastest at transacting across borders for their customers. Thirdly, they want to also be the most transparent because there's a lot of hidden fees that customers are not aware of, and banks are notorious for this. And fourthly, they want to have the largest multi-currency coverage across the globe. So those are the four things that they're focusing on, but two of those are probably the most important, which are going to be low cost and speed. And an anecdote from Jeff Bezos was once he was asked about, well, what were in 10 years, what could change about customer behavior? And he inverted the question to ask, well, what's not going to change about customer behavior? They're always going to want low cost and they're always going to want things fast. So if Wise is able to deliver at least on two of those four drivers for their business, they're going to have at least a decent amount of success, I believe. So let's dissect the problem that Wise is trying to solve. Now, these problems are still persistent today, despite them being present for 13 years. If you were to go to your bank today to say you want to send money to another bank, somewhere in Europe, let's say, and you're in America, then it's highly unlikely that your bank in America and the bank in Europe have a direct connection with each other. They're going to be using some intermediary banks in between. And that was likely going to be the SWIFT correspondent banking system. And that is a system that has been built upon, let's say, a network of 11,000 banks, whereby where you send money to the next person, they would send it on to the next person. It's almost like 6 degrees of separation between people. I know a guy who knows a guy who knows a guy. And yeah, that works, but is it actually efficient in this day and age where things are very digital? What tends to happen is that when you send money, there's a lot of hidden fees. And if we look at this, basically, you are the original sender, you're sending money across to your bank. There's going to be more than one bank, and they might have to connect to the SWIFT network and then format the data and then actually double check whether or not this transaction is fraudulent. Is it money laundering? Is it through terrorism? And that costs money in order to abide by all the regulations that are in place. And every bank in between wants to take a share of the pie. So whenever you send money, you're usually unaware exactly what you're going to get at the other end. Even if you looked at the currency conversion rate, you'd find that whatever you get at the end is a lot less than what you expect. The business has evolved a lot, as we said, from their initial founding. However, they did start with expats and focused on more the high-value expat in terms of the amount of volume they would send, as opposed to, let's say, a few £100. They were looking at more like thousands and thousands of pounds. So that has since changed, and now they're targeting small to medium businesses, small to medium enterprises, financial institutions as well. And they have some key partners, and we'll discuss the banks as well, but some of those banks are intermediary banks. Whenever they can't reach a person on the other end, they would still use those. They haven't completely gotten rid of those, and it's not a pure peer-to-peer system as they originally conceived the idea. They also pair it with some payment processors as well, such as, MasterCard, Visa, possibly Adyen as well, and alike. But, we're going to discuss that as well in the later part of the video. But the key ones here are going to be the financial regulators. Let's say whichever country they enter, they need to make sure that they're licensed and approved by the financial authorities in that country in order to be able to send and receive money abroad. And that plays a huge part into their actual, let's say, moat, if you were to say they have one in that regard. Okay, as far as their key resources that they built through those 13 years since their founding, their payment rails would probably be number one there, because without this, nothing functions, because they have a highly skilled team of engineers, 800 of them or so at this stage, and they are the ones that are powering this network of sending and receiving money. But without the regulatory licenses, again, nothing would function. So they need this kind of pairing of like, we're going to be, let's say, going and lobbying in a way with these, financial institutions in order to get these regulations and approvals that we need in order to, gain a larger share of the network. The other thing is the banking partnerships. They will continuously keep needing to gain more partners, and you'll see how that evolves throughout the story as we discuss it more so. The last thing I would say is the brand. Achieving, the high status and trust is a thing that takes time, and they've built this upon layer on layer of, trust and gaining, more. Let's say they're focused on transparency, number one, and the customers probably are appreciating that more and more so. However, you could say there's an argument that most customers are not that price sensitive towards these hidden fees, and they get away with a lot of these banks for a long time. So it will take time to, teach and raise awareness in terms of what benefit it is to, come and become a customer wise. But I think over time, this will become a larger driver for the business. So let's bring everyone up to speed from their founding to now as to what's happening with Wise. As we said, Wise started off just as a money remittance company, peer-to-peer, transferring. However, since then, they've evolved a lot. 2016, they started focusing on gaining approvals across the globe. They started with the UK and gained approval from the Financial Conduct Authority. And since then, they've launched a few key products, which is the Wise account, which allowed them to hold customer funds as opposed to just transferring money. And since then, they've introduced the Wise card, which is a means for them to, just transact or, use a card for day-to-day purposes as opposed to just transferring. And then they've rebranded to Wise and got listed in the London Stock Exchange. And since then, they've gained more and more key partners across the globe. As opposed to just intermediary banks, these banks such as Nubank, if you've heard of them, a very exciting bank in South America, would use the white label version of their payment rails. And they were working with Standard & Chartered as well as Morgan Stanley recently. The key one here I like to highlight is the Swift partnership. And that is a vindication, I would say a validation of what they've built to say that Swift is partnering with them. Well, we started off disrupting this and now they're partnering with us because they can't build anything better than what we have. I think that's a strong vindication of what they've built and the strength of their payment rails and their network. So what about their key products? Now we've touched upon Wise account already. So it's basically a account that they can hold funds in and transfer money whenever they need it. Wise Business is almost identical, except just adds invoicing whenever businesses need to send invoices to customers. And Wise Platform, that's basically the partnerships they're building with the white labeling solutions. And I can see this expanding more and more over time. And it's an exciting business because there's more avenues for services and products that they can deliver to customers. The only thing I would add here potentially as a fourth product is the Wise card, and we'll discuss that shortly. So Wise is now generating 56% of their revenue from cross-border payments. If you had told the co-founders probably in 2011 that they were doing half of their money from cross-border payments and the rest from something else, they'd probably be just as surprised because, that was not what you expected the evolution of this business to be. But given the tailwinds that we've seen recently as well with the large spike in interest rates, you've seen their interest income ballooning to 26%. And that's just based on the amount of funds that customers are holding. They want to generate some cash or income from that money. So they give them a portion of that back and the rest they pocket. Additionally, they have 18% coming from card revenue and other sources. And here you can see how the evolution of the revenue has been over time for the last couple of quarters. I didn't want to go all the way back because the way they were disclosing this information has changed. So I went only as far back as when they started disclosing card and other revenue. But over time, what you're noticing is that the card percentage revenue has gone up from about, let's say, 16% up to 23%. So this is a growing part of their business, as well as the net interest income. You can see that this is a growing portion of their business as well. So that could be the case. And it's just something that we also need to be mindful of, is that interest income or interest rates may change over time. And that might have a significant effect on this business and how it's being valued. So I've gotten this slide from the investor presentation deck of last year, and there's a few things going on, but I've blanked out a few less important ones. The key things to focus on here are that 63% of payments are instant, and that's within 20 seconds, let's say. There's not a lot of businesses that are able to do this in this field, so that they're able to deliver huge value to the customer. The other thing is that 40 currencies are available right now, and we'll touch on that a little bit later. They also have one global treasury function, which basically, let's say, they've kind of conceded the fact that they can't be a peer-to-peer system whereby you have one person on one side and then another person on the other side, and they just swap money across, because the nature of remittance and how money is being transferred worldwide is not so bidirectional in nature. Therefore, it's not a one-to-one ratio. Sometimes if you look at the corridors where money is being transferred, specifically the largest corridor of them all, which is the USA to Mexico border, most money is being transferred, let's say 60 billion one way, and only 5 billion goes the other way. So they need to have a way to balance out that difference in terms of when people need to send money to the other side. And that's where they have the liquidity function available in order to do that. They also gained 65 licenses, which, across the globe, that's just another part of their moat in terms of the regulatory, system that they've developed. The most important thing, and I want to focus on this slide, is the last thing, which is the direct connections. They have 6 direct connections to the actual central banks of the countries they're operating in right now, 6 of those, and 2 on the way. And I can't stress this enough, how important those connections are to their moat and their competitive advantage that they're building. So they can reach up to, in theory right now, 40 direct connections, which is basically for each country had its own currency. They develop one direct connection. And one of those is actually to, Europe or the euro. So that covers the entire, area of Europe as well. So let's look into that a little bit further and why that's so important. Now, what you'll see here is that the banks themselves are, Euro, England, Hungary, Australia. I think that's Singapore, Indonesia. I should probably say it's Indonesia. And then Philippines as well. So those 6 direct connections with 2 more incoming, that allows them to drive their costs down. And the most important thing, as we said, in terms of value for the customer, is a lower transaction fee. If you're able to build a direct connection with these banks and therefore bypass the intermediary banks that you were working with prior, therefore you're rising up that food chain in terms of vertical integration within the country. They might enter a new country with a partner bank that they need, but then eventually they work and gain trust within that system and develop that direct connection where possible with those central banks, and therefore reducing their costs, as you've seen in the UK, by 9 times. And then, instant transfers would rise, as they did in Australia, from 24 to 83%. So those are some really, really important competitive advantages that are not easy to replicate and take time and take a lot of trust. But as they gain these, regulatory approvals, it kind of builds a critical mass whereby more and more people are willing to work with them, just as you might see as well with the banking partnerships they've developed on their Wise platform. As more banks sign up, as more people adopt their rails, therefore it becomes easier and easier. And this thing can, snowball out of control. And it's also evident from the metrics, as we've seen, that their 63% of their transactions are now instant. Now, could this number keep rising? Sure. It could become 80% or so, but that's just another way that they're driving, value to customers. The other thing is, we haven't mentioned these specific words, but they call them out in their actual investor presentations, is that their take rates are going down. The take rate is actually made up of 2 things: the mid-market currency rate, as well as the fee on top of that. Now, with normal banks, they would never charge you a mid-market currency rate, because a mid-market is basically the bid-ask spread, and it's divided by 2, whatever it is. So basically, whatever the range is, they're going to give you the one that's in the middle. And that's what you usually see if you were to type it into Google. That's the mid-market rate. And that is the rate that Wise tries to give you. Whereas if you were going to your bank, or let's say using other remittance services, they might give you a little bit higher. It's not to say that they're lowest provider in all of the, let's say, corridors where money's being transferred. But in general, over, let's say, an average, they have the lowest take rates across a lot of competitors. And you'll see that later in a few slides when we'll look at that. And they've also gained increase in volume transfers, especially to India. That's very important. India is a huge corridor for money transfer, especially from, let's say, the UAE to India or the US to India. It is a very, very lucrative corridor that they're trying to get a little bit more exposure to, as opposed to where they started off in Europe. And here you see the Wise platform, which we've not discussed a lot. We've mentioned Nubank, but their connections to these banks and white labeling solutions they're providing. Let's say they've worked with Google Pay, Interactive Brokers, Apple Pay, Nubank, and a few of the key banks, Monzo and N26, these were early adopters, have gained a lot of traction since then. And as such, they gain extra value or revenue whenever they are actually making money as well. So let's take a closer look at what things are like. So in terms of revenue geography and where they're making the most headway, obviously they had their start in Europe, so you can expect that to be slowing down. But actually, that's not the case. You can say that, yes, it's a little bit slower in London at 28%, but that's very respectable for a 4-year CAGR of growth. That's beyond, let's say 90th percentile in terms of what you would expect a company to be growing at that rate of that size. And therefore, again, Europe's growth at 33% CAGR. You have North America growing at 33%. So that's compounded annual growth rate. Each year, they're growing 33% year on year. And as you've seen with their partnership with Nubank, that's the rest of the world revenue falls under that area as well as South America. But Asia Pacific, that's the UAE to possibly India corridor or Japan, the Philippines, that's another lucrative area for them. Can I see an area of weakness so far in those growth rates? Not really. They're doing well in all areas, actually. So we focused on the revenue per customer, but now let's look at the volume per customer. How much is each customer sending? And over time, let's say the general trend has been that cross-border volume is not slowing down. It's still growing at a rapid rate. There was a slight little, wobble towards the, financial year of 2024, but that's, continued to tick upwards, being driven a lot by the revenue from the business or the volume from businesses. However, the volume from personal customers seems to, at first glance, look like it's going down. However, the reason they disclose why that appears to be the case is because the personal customers who hold cards and are not transacting, are just using those accounts either to gain interest or just, for their day-to-day habits, are not transacting in terms of volume. So that's driving the volume per customer down. So it's nothing to worry about. And I don't think it's a metric they actually will continue to disclose because it's quite deceiving in terms of what it's showing. But I thought I'd just show you some of the data that you might not be getting elsewhere at this stage. So let's recap. I know there's a lot of numbers, but these are important things to understand about this business, the size of this business. They've got 12.8 million customers. They've grown 5.4 million new customers in 2024. And now they're having 118 billion in cross-border volume, as well as operating in 160 countries and supporting 40 currencies. Those are the key things to understand. So as far as their capital allocation strategies, again, there are 4 things that we can do with capital as allocators. We can either choose to invest in higher ROIC projects, so higher return on invested capital projects to gain a better return. We can either choose to, give a dividend or buy back some shares to increase the value to shareholders, or we can choose to do some mergers or acquisitions if an opportunity arises, or we can pay down debt. Those are the 4 things that we can do. So from those 4 pillars of capital allocation strategies, which ones are they currently pulling on? Well, the main one they're focused on is improving their ROIC. And the way they go about this is improving the infrastructure rails they currently have, building direct connections with central banks across various currencies, and also improving their product development cycle. And that ultimately leads to a reduced pricing and increase in volume that they're delivering for their customers. And that obviously is the feedback loop that drives higher ROIC. The other things they could be focusing on is some mergers and acquisitions. But at this stage, because of their growth rates, I'd love to see them grow much, much larger before they take on any of those risky bets. They could also choose to pay down some debt, but they don't really have that much debt to speak up. It's minuscule at this stage. Or they could choose to go out and pay a dividend or buy back shares. Now, they are doing one of those, which is they are buying back some shares. However, it's only to offset the dilution they're having from stock-based compensation. And we'll get onto that a little bit later in the video. So what about the culture and management of this business? Now, Christo Carmen is the CEO and co-founder of Wise. As you recall, there were 2 Estonians. One of them has since left, but Christo Carmen has been leading the charge. And he's actually a very significant shareholder of the business as well, with 18% shares outstanding. He does also have special voting rights. So there are those pesky Class A and Class B shares. So that's something to be aware of. But I guess as an investor in this business, you would just have to bear that in mind. Emmanuel Thomason is the CFO, and he used to work for Delivery Hero, and he helped them through their IPO. But you can't judge this man on this business yet. However, he does come with some, good credentials as well. Harsina, the CTO, I guess you can't also really judge him much, but this is the C-suite team. He was in charge during a period where Christo went on a sabbatical for 3 months when his son was born. So you could say that he could hold the reins for the business, at least for the time being. So this is the team so far. And it's good to see that the approval ratings for Christo Carmen sit at 80%, and as well that 73% would recommend working there. These aren't stellar numbers, but at least it's not bad, I would say. So what about the culture of this business? Now, business, I would never usually spend a lot of time looking at culture. I know that probably is a fault of mine because it's really hard to dissect the culture, but you can see that actually for Wise, it's a lot easier to dissect because, the net promoter scores are fantastic. They're some of the best in the business, as well as they're very transparent, as we discussed in their actual transaction fees. They're very transparent about that, but they're also very transparent about their roadmaps. They're sharing their roadmaps publicly. And that just shows this is what we want to be judged on. We have providing you our actual roadmap in terms of what we're planning. We want to reduce pricing. We want to improve coverage, speed. And I feel like as a competitor, I'd be terrified of a company trying to show me everything they have as if they're saying, come and get us. The other thing is, the culture, they've got some weird, Finnish things, which is in their headquarters, they've got a sauna. And that just shows you, I guess there's a fun, playful element to the company as well. So they've got this thing now. This was a run they did. It's actually an unlisted video. So, you're getting some really sneak peeks here in terms of what they're doing. But they started this naked run. And, I guess the culture, there's a lot of seriousness, but at the same time, it's a lot of fun. So it's good to see that this is actually some of the things that you'll get as an employee in this business, that it's a fun place to work. So on to the financials. We focused a lot about the fundamentals of the business. I want to focus now on the financial, because sometimes this is the area where most people slip up with a company like this, especially fintechs. So I've tried to break it down as simply as possible in terms of how we should look at these numbers. All right, so let's get into it. So I've broken down the financials into two funnels. You have the IFRS reported numbers, which is the European standardized accounting methodology, versus how you would have it in the US. As GAAP reported numbers, you may be familiar with that. And then you have the WISE reported numbers, which is present in their annual reports as well. The main key difference here is that the top line is completely different, and it changes the whole funnel all the way down. WISE as a company is very worried about the fact that their net interest income is ballooning to such a large amount, and it's accounting for such a large portion of their revenue, that ultimately it's a very volatile part of the business that they are concerned eventually will plummet, and then the business valuation will change dramatically. So what they've changed as of last year is they only recognize 1% of the net interest income they make. And the remainder is being paid out to shareholders, and the rest of it will be retained. We'll cover that in a little bit more detail. But basically, that's the crux of it, is that they're only recognizing 1% of their net interest income. Whereas in the IFRS reported numbers, they need to recognize the whole net interest income that they collect. And that's where the discrepancy lies. Which of those numbers should you trust? Should you actually look at the numbers they're actually collecting in terms of cash into their banking, into their accounts? Or should you look at their, this is what we're kind of like our conservative numbers are going to be? I think you need to be somewhere in between, because, the target 1% may not be so realistic to say that interest rates are ever going to go down to 1%, but somewhere in between that range, let's say a free cash flow between 487 and 247 may be where things normalize. Next, let's look at the gross margins for this business. Now, what you can see here is that their gross margins have been ticking upward, which is fantastic. Their operating margin has been ticking upwards even faster. Where could those numbers end up? I can't see this company being as, a competitor, let's say, to Visa or MasterCard with their 97% and 100% margins. However, could they reach a high of 90% gross margin? That's a possibility for this business. And it means there's a little bit more room for growth in that metric, at least, before we go down to the operating efficiencies. So this is another funny chart to look at, because this just shows us the free cash flow is ballooning out of proportions. But the reason that it's appearing so is because of the large customer balances they're holding. And that's why it's so difficult to value some of these fintechs. You need to, account for that and the change in net working capital that's happening. So I do go ahead and adjust for that, and I'll show you what that effect has on their free cash flow. So a brief look at some of the key financials that tell a story now. I wanted to paint a picture for everyone here, because sometimes you get lost in the numbers. 45% revenue growth rate for the last 4 years compounded, and 112% net income compounded for the last 4 years, as well as current assets, which are the customer balances, have been growing at 48% for the last 4 years CAGR. So those are fantastic numbers. Those are just huge numbers. And the other thing to point out is the ROIC, the return on invested capital for this business. You probably won't find this number on one of the financial websites, because I've had to adjust this number myself. So we've netted out the customer balances in order to arrive at 52% ROIC, and that's a fantastic number. Given their cost of capital of, let's say, approximately 10%, it is approximately 10% actually. This is a fantastic return. for this business. And then when you net out the excess net income that they're getting, you get a return on equity of 36% with an interest coverage ratio, which shows you how, let's say, how much they can cover the cost of their debt. They can cover the cost of their debt very, very well. So this business is, ticking on all gears, and it's doing fantastically well. So let's look at some of the other things to focus on here, which is the shares outstanding. Shares outstanding have been growing steadily, very, very slow growth of 1%, and I am not too worried about. They are offsetting some of that dilution, as we said, because whatever excess net interest income they're making, they're putting that into an employee benefit fund, I guess, trust, and buying shares back and giving it to the employees. So you're seeing a slight uptick, but for 1% dilution, I am not too worried in terms of the growth rates they're having. And you can see the orange line is the shareholder yield return, which is the dividend yield, which they don't have any, plus their buyback yield, plus any net issuance of debt as well. But, that number I'm very, very happy with. They're around 4% in terms of their buyback at this stage. So that's pretty good. So let's look at the competitive landscape in the actual remittance and money moving business. Now, we discussed SWIFT as the traditional bank tool for moving money, but you have to deal with one of the juggernauts or incumbents in Western Union, which is moving a lot of volume across the world, and mostly smaller volume, or at least volume per customer, than Wise, because they're dealing with remittance to poorer countries, but they have been around for a very, very long time. And as such, because they rely on cash transactions as opposed to digital for most of their, volume, they have to have ways to manage that cash and keep that cash safe, and regulations and all that. So their gross margins are around 40% versus Wise's 80%. So you can see a huge difference already from the top line, gross margins. That Wise is doing a lot better. The other things to look at here is one of their main competitors is going to be Remitly. So that's one of the competitors in the US, and they have been growing as well rapidly in that space, but we'll get to see how they compare to Wise soon enough. As far as some of these other ones, which are, we've already discussed them, Nubank, Monzo, and 26, these are all partners of Wise, but they already use the white label solution. Whereas Revolut actually is another neobank, but they don't use Wise's solutions just yet. But they allow their transactions to be free cross borders, and allowing that to be a loss leader for them in order to recruit and get these customers on board. So that's just the whole, landscape right now. It's not all encompassing, but just to shed light on a few of the things there. And you might also have seen the logo for Zoom, which is a PayPal tool to transact, but they charge such high fees. I don't even think it's worth mentioning at this stage. I don't think that's a very successful one. So how are these companies doing quarter by quarter in terms of moving volume of money across the globe? Now let's take a look at the volume excluding the US. I believe this is the chart for, and you can see that Wise is growing so fast in comparison to the incumbent, which is Western Union. And Western Union has split up into, let's say, overall and digital, but just let's look at the overall. Regardless of which way you look at it, Wise is the fastest growing. And the second closest competitor is RIA, which I didn't mention earlier. And then you have Remitly here rising fast as well. But in terms of just volume, there's no competition between Western Union and Wise as well. So let's look at the other chart we have here, which is just the USA outbound consumer volume. So again, we said one of the biggest corridors is going to be the USA to Mexico corridor. And you can see that this is a weakness of Wise so far, is that they're not really challenging that space. But again, that's a good thing, because otherwise there's no room to grow, and there's no room for further investment or returns. So you're going to see that they have room to grow in that area to take market share away, but they need to displace Remitly as well, or even gain market share from Remitly. Whether or not they're able to do that, I don't think it's, the thesis is going to be built around just the US. There's so much more money around the world to be moving. And as well, we mentioned of all the other corridors as well. Sorry, everyone, I added this slide later on in making the video because I forgot to include it initially. This just shows us the take rates for Wise versus the competition. And as you can see, there's no real competition in that regard. Their take rate is order of magnitude less than nearest competitor. I think the reason they are able to get away with this is because their cross-border volume amounts are much larger than their nearest competitors. And as such, they can compete at such a low level of a take rate. So another chart here that highlights the benefits of working with Wise and their operating efficiency is they've started to leverage AI in terms of making the onboarding of customers a lot easier. You can see the amount of minutes it takes to register and the amount of time it takes to transfer money. It's by far faster. Like, I know we're talking about minutes here, but it really does make a difference for some of these customers who just want the quickest and easiest tool to transact. So let's wrap things up by talking about the competitive advantages of this business. Now, what we can see here with the Hamilton-Helmer framework is that there are definitely elements of scale economy for this business, because the more volume you have, the lower you can drive your take rate, and you create a barriers to entry to any competitor, specifically a barrier to success. I don't think it takes a lot of money to start in this business. However, to be as successful as them, as having the lowest take rate, that really does mean that you need to be competing at that level. The other thing is there's a huge element of counter positioning here, which just makes me really happy, because finding counter positioning businesses is a little bit more difficult. The fact is that these banks, incumbents who have been present for a very long time, will be cannibalizing their own businesses. And if you know about the innovator's dilemma, that these businesses, if they were to say, or instead of charging their high fees, had to, bypass all the other banks and charge low fees, that would just eat up into their margins and revenue. And they didn't want to do that. They didn't want to take the small take rate when they're taking a big piece of the pie. So that's where they have been able to build the name for themselves, where banks didn't want to venture into. The other thing is they do have a coordinated resources at this stage, I believe, because those payment rails are magic. They are being used and being validated by Swift using them. They're being validated by the other banks themselves not being able to build them, because a lot of criticism that Wise has gotten is the fact that, any bank, any other financial institution could just build it and bypass them. Well, they haven't. They've been actually, banks such as HSBC has actually tried to launch one and then failed and floundered. So you can see that they've built something there that is, built on 13 years of work, and they have one of the largest, engineering workforce available in, I think, the world. And they have 800 engineers working on this project. So a cornered resource in terms of the infrastructure, in terms of the regulation and direct connections with these central banks, and the trust built in. I think that's a very, very key, a cornered resource that they have. So as far as right now having 3 key competitive advantages, I could have given them as well something about network economies, peer-to-peer. However, the value of an additional, let's say, node on the system does not really increase by an increasing of 1. And as we said, this is no longer a peer-to-peer system. They are working now with liquidity providers and hedging positions and all of that. So that's not a big driver in terms of competitive advantages. I could have given them as well, let's say, processing power, and that they've been able to drive everything lower in efficiencies, but we'll wait another couple of years before we consider that. As far as brand, the brand is definitely being trusted. It's gaining word of mouth, trusted at the financial level, trusted at the customer level, and it's one of those things I would say definitely starting to gain traction for. The last thing to say is, again, to wrap it up, is the willingness to sell. So willingness to sell usually is not as clear as willingness to pay, but willingness to sell means that the financial regulators are willing to provide them the direct connections because they've shown that trust. And that is something that's not easy to gain in this market. The other thing is the willingness to pay. So customers are definitely willing to pay because the take rates are going lower and lower. And they are, they have this mission of driving these take rates really almost close to zero. But I've never seen them actually say that out loud, but they're just, maniacal about driving this take rate lower. So there are 5 key risks for this business that I've wrapped up. The regulatory risk is basically built on trust. If there is any breach of that trust, they could be fined. They could have their direct connections cut. And it's not unforeseeable that these things happen because legislation, politics does play a part in this. Things of this nature, it's unpredictable. So there could be an element of regulatory risk. The other thing is FX currency risks. So basically they haven't managed to hedge positions. There's a change in interest rates. Things do play a part in that regard. So interest rate risk, we discussed as well the fact that there could be some headwinds moving forward. Interest rates may dip, and we'll look at a chart about how that could affect them in the future. Partnership deterioration. So let's say, for one example, that their white label solutions are no longer servicing the banks as they need to. Or maybe they see them as a competitive threat and they're like, no, we're no longer going to be using you because you're displacing us banks. That could be a potential issue. The other thing is potential disruption and deglobalization. If the world, heads towards a state whereby, let's say, Indians, I've read something somewhere, Indians were being kicked out, at least the ones that were coming illegally. But, let's say legally, they're saying, oh, no, we're going to onshore everything and everyone's going to onshore everything. Money across the borders could decrease. That's a theoretical risk. I don't believe it's going to be a huge thing. The other thing is the disruption part of that. So disruption by digital currencies. So it could be the case that everyone's been vouching for stable coins, and banks have been rallying around this idea of researching whether or not they want to create a central bank coin for each country. So guidance, what is the company guiding to at this stage? Well, what we can see here is that they're seeing really good growth in their business, and the underlying income, which is their top line, the revenue, all including the total income from the interest as well, that's about 15-20% they're guiding to. How long for? I couldn't tell you exactly that, but their profit margins, they're estimating will be 13 to 16%. So it will tick down from where it currently is, around 20% or so, because they're saying that this is what's going to normalize that. So please don't expect it to continue at this high level as we discussed before. Again, their take rate, they continue to say that we're going to keep driving our take rate lower and lower, which is good to see. And this is where I wanted to point out in terms of the guidance. Now, wherever this company goes, interest rates will follow. With the whole history of interest rates that we have from the 10-year U.S. Treasury, we're using that as a benchmark. We can see that historically interest rates have gone up and lower. We're used to a history whereby we were living at 0% interest rates somewhere here in 2020 following COVID. But things have been ticking up and we're like feeling the pinch. Of course, inflation hits hard. However, is this completely out of the norm compared to the history to 1965? No, if you were to draw a line about where the mean is or where the median is, you'll be seeing that it's probably somewhere around 5%. So are we that off a normal level whereby interest rates could stay here for much longer? I mean, it might be the case. Or it could tick down because, if you were to watch this like a hawk and say, oh, it's going to go. All I would say is that just have let's say, goalposts of where you think interest rates will go. Do you see them going down to zero again? No, unlikely. So the key thing about them going down to zero, or at least trending downwards, is that you'll see here that over the last 20 years, what were the best assets to hold? I just thought about this and I'm like, okay, well, one of the best assets to hold for the last 20 years, let's say to 2005, were REITs, because, these are highly levered, instruments to go out and buy these, real estate transactions and, fund them. And they require lower interest rates to be profitable. With higher interest rates, that has reversed. The equation has been now actually any kind of company that makes money off of interest is actually going to be doing well. So do we foresee higher interest rates for longer? I do believe so. That's going to be the case, and maybe an uptrend potentially from where we started. And therefore, as such, will banks and fintechs make more money based on that interest rate? Yes, that could be the case as well. So that's just something to frame things in terms of what we see the tailwinds could be for this company. So I've carried out the valuation in 3 different types. One of them was the free cash flow to equity, DCF. The other one was the free cash flow to the firm, DCF. The difference really is between these two. One of them is more used whenever you value a bank. The other one's more for just a regular company that generates free cash flow. But given this is a fintech, it kind of falls in the middle. However, I've done the adjustments for each one to show what this business is worth. And I've used a 20% revenue growth rate for the DCF, or in terms of the DCF for the free cash flow to equity, I've used a 20% growth rate in the net income. And the ranges I've given here are based on the higher end, it's with the 20% growth rate, but we're starting off with the current numbers that they are giving us. However, I did normalize these numbers for the lower range so that you're getting a complete spectrum of what the situation could be like if it was a normalized, for that high peak in terms of interest rates causing higher revenues, total income as well. So you can see for both of them, they're fairly similar. In terms of the high end, they're both within the 13 pounds. And then on the low end, 8 pounds 60 for the free cash flow to equity, with a 10 pounds 40 for the free cash flow to the firm. So that suggests that we're pretty close to fair value for this business. And the last thing is the total shareholder return. I've been a bit more conservative there, but I adjusted a few of the ranges, saying in the worst case scenario, you're going to be earning a rate of return at 6%. And it could go as high as 13%. And I'm generally fairly conservative with my numbers. So I would say this business at this stage is really offers a good opportunity for us to get good returns. So that's it for this video. Now, if you did enjoy the content, I would definitely appreciate a like and a subscribe, as it does help the algorithm as this channel is still growing. If you did find the content useful, do leave me a comment letting me know which parts were most intriguing and if there's anything else I could improve upon. All right, but hopefully I'll keep this going and I'll put out some more videos of more companies that I find interesting. So I'll see you in the next video. Take care.